Welcome to the mid-year market update from Principal Wealth Partners. I am Julina Ogilvie, and I have once again our founder and CEO, Bob Paolucci. Bob, welcome back first.
Thank you. Happy summer.
Happy summer. So I think the timing of this video is interesting. We just had our internal investment committee a few days ago. And so I'm going to try and summarize what our agenda is here today. And I think it's really important to note that we believe that the second half of this year will look very different than the first half of this year. I also think that it's important to note that the economy and the market are not always in sync and aligned. And I think this year is a great example of that. So we are going to try and cover what the Fed has been doing and what they're possibly going to be doing in the next year, which some are even questioning, are they going to revert and actually start cutting rates? We're going to talk about inflation. We just saw inflation numbers yesterday. No one's talking about the fact that core inflation has actually been down over the last few months, begging the question, has headline inflation actually peaked? We're also going to talk about valuations. The market is now cheap again, questioning, did we overcompensate with the decline that we've seen? So we now have a bear market in stocks. And we also have, at the exact same time, the worst bond market on record. So there's the summary. How am I doing?
That's pretty good, Julina.
Okay.
Absolutely. Yeah. And, again, I think these conversations that we have are a little lengthy. But what we don't want to do is what everyone else does, give you some irrelevant talking point and not give you the data behind it. We want to do the opposite. We want to give you a high level view of what we're talking about, what we see, what we're thinking, but more importantly, just so you understand we're not blowing hot air at you, show you why we're thinking what we're thinking and what has backfilled the information. So hopefully that level of education, explanation, and context goes a long way to make you feel better, and at least will give you some color behind what you are hearing from us.
Yeah, absolutely. And so why don't we start with everyone's opening their statements, I'm sure, for the middle of the year, and let's talk about where we are in the first half and start maybe with the stock market.
Have at it.
Okay. Can you see it? Sorry.
Yeah.
Okay.
So what you see there is, this is a very one-sided chart, but since 1907, drawdowns from prior highs in the market. Notice there are no increases. This is simply a drawdown chart. So what you see on the far right-hand side above the 2022 is a decline of, at its peak, 24%. The actual number was down 24.5%. But to keep this simple, we took the decimals away. So a 24% decline on the S&P 500. Anything greater than 20 is coded a bear market, right? So the S&P 500 officially entered a bear market.
And I think one of the things I love about this slide is, as uncomfortable as it is with a 24% decline, you can see that these clearly happen every few years or so, every 3 to 5 years. And so this is not completely uncommon.
That is absolutely correct. What we didn't do, they're there on the chart, but what we didn't do was code or put a number next to every 14, 13, 12, 11, 10, 9, 8, 7, 6, 5% decline. There are many of them.
Sure.
Down market, up markets, and vice versa. So just to give you a little insight, these are some of the more notable ones. We tried to tag the drawdowns that are 14% or greater, and there are many of them.
Absolutely. And I think also what might be helpful is the next slide, which kind of dives a little bit deeper into a few of the indices, if you want to walk through that.
Sure. Yeah. I mean, we talk about this a lot. So the high level index, the S&P 500, the largest 500 companies domiciled in the United States, that index went down 24.5%, but the holdings inside of the index, their average decline was about 30%. So what's happening within the indexes, within the individual holdings, is far worse than the glued together index. You have the utility sector, which was down, just a few percent so far for the first half of the year. In essence, doing better than technology, doing better than the S&P 500. You have the energy sector, which is actually up year to date, which is masking all of the other companies that are down and sectors that are down actually much more than the stock market. So there actually has been much more carnage at the individual holding level in the market than most truly understand, which also, we should point out, if there's much more to go, is the average stock actually going to go down by 50% when earnings are rising, when the economy is still strong, right? We actually have a strong economy. If we didn't, we would be in a recession. When consumption is high, if we didn't have high consumption, we wouldn't have any inflation. Very unusual. So we'll get into this later, but we believe that the market is a little too bearish here.
Absolutely. And also what is extremely unusual as well is we are always talking about diversification. We're always talking about owning bonds for environments like this. And Bob, how often do we see these two go down at the same time?
It's very rare. It is very rare. But it was also very rare to have 0% interest rates.
Right.
Blaming is easy, but ultimately, had the Fed maybe moved the needle on rate increases last year, when things couldn't have been any better, there obviously would have been less of a decline in bonds this year, but it was quite concentrated into, so far, 2022. So all of their words and actions were presented in 2022, right? They said right at the beginning of the year that it's very likely we'll increase rates in the spring and by quite a bit. So buckle up. And almost immediately from January 3rd to the end of January, the market declined about 15%. The bulk of the decline is still, looking back, the first 3 weeks of January. But they took action. They talked yields into place. They in essence moved bond yields with their words, and then they backfilled, and they are still backfilling with their actions.
Meaning, Bob, that the decline in the bond market and candidly the stock market began before they actually raised interest rates, right? It was the market anticipating that move.
Yes, and it was the words of the Fed.
Yeah.
They cautiously, carefully planted those words so the markets could, get out of the way, start to price it in. Need your help.
And pricing in, they certainly did, right?
Yeah.
This is a visual of the bond market going back to the 70s, correct?
Correct. Yeah. And why did bond prices come down? Well, you have to understand that bonds are issued all the time, whether it be corporate bonds or government bonds. There are bond auctions that the government does every month. And, over the past 3, 5, 10 years, when those bonds were issued, they were issued at current interest rates. So if current interest rates were 0 and 1 and 2%, do you think those bonds are less attractive today when you can get the same maturity, same credit quality with a yield that is twice as high?
Right.
So those bonds don't go away. They just don't look as good. And what happens is the price of those older bonds with the lower yield go down.
Right.
So then if you buy that bond at a discount, the lower yield ends up being sort of at par with new yields. And that's what happened. So you really saw, if you tie the entire bond market together, about a 15% decline. Now it's about a 10% decline. And if you're paying attention to the difference, yeah, there has been almost a 5% return in bonds over the past month. Right. But at its peak, it was a 20% decline in bonds.
Amazing.
Amazing.
And I think I personally think the better visual is this slide.
Yes. Yeah, how unusual that has been. And, for a lot of diversified investors, that are out there, whether they're our clients or not. If you have a diversified portfolio, you have stocks, you have bonds, you have US stocks, you have foreign stocks, large companies, small companies. Well, your bond portfolio throughout the year for most investors, not necessarily ours, your bond portfolio was down as much as your stock portfolio. And that is highly unusual. But that was very likely overdone. And we believe, and we can get into this later, that the bond market will very likely provide stock-like returns in the second half of this year. Why? Well, the Fed is just about done with their rate increases, and the bond market is already starting to price that in.
And Bob, can you talk a little bit about, and maybe this visual will help as well, talk about why you think that they're almost done?
Absolutely. This one will be a little confusing, but we'll give it a go. So the benchmark interest rate that a lot of people on TV, economists refer to, is the 10-year Treasury index, right? It's linked to many things. The 10-year Treasury peaked at about 3.5% a few weeks ago, and it is now starting to come down. It's now about 3%.
Which we show right here.
Which we show right there.
Yep.
The overnight rates, or Fed funds rate, if you can circle that one, Julina, that is what the Fed actually controls. They move that dot, that 1 month dot, let's call it, up and down as needed. With another 75 basis point increase, which is very likely to be laid out this month in July, that will bring the short-term rates up to approximately 2.25%.
Right here.
Yeah. However, the 10-year Treasury is starting to come down. Why? Well, twofold. Number one, at a yield of 3%, when this time last year it was at 1.25%, it's now looking certainly more appealing than it did last year. So whether you're an institution or an individual, bond yields look great. You're getting 100% more yield. Right. If you compare it to 2020, you're getting exponentially more yield, right? Because the 10-year Treasury back in July of 2020 was about 0.5%. So now, 3% looks incredible.
Yeah.
So there's a lot of money starting to flow into these now higher yielding bonds. And that is bringing the yield down. Why? Well, when you have a massive inflow of dollars, that brings the price up. The price up brings the yield down. Very simple. Not to mention, it is a safety trade. So some big institutions are betting, hey, if we do have a soft recession here, we might as well put more money into these guaranteed bonds now, because we're getting paid so much more. So it's twofold. The yield is more attractive, one. Number two, it becomes a safety hedge.
Right.
So the danger here with the Fed, and the reason why we think they are just about done increasing interest rates, is they don't want to take that 1 month dot, if you can circle it one more time, and move it up to that 3% range, because you will then have a short-term versus long-term inversion. There are many that are referring to the 2-year, 10-year inversion, meaning 2-year interest rates are higher than 10-year interest rates. Yeah, that's not great either. But the real one to look at is really the shorter term 1 and 3 month rate being higher than 10-year. Why is that a big deal? Well, ultimately, the lending of money in our economy, in most economies, is what fuels everything, right? Most companies don't pay for planes in cash, they finance it. So whether it's small items or big items, the world runs on credit and borrowed dollars. Do you think banks will lend money for a long period of time if they have to pay 3 or 4% on deposit and lend out at 2.5 to 3%? Of course not.
Makes no
they
sense.
need to make a spread. And the Fed is keenly aware of this. So we believe that the Fed is going to talk the talk aggressively to scare the market and consumers into thinking they're going to over tighten. And that will be this month. August, the entire government is on vacation, so there is no Fed meeting, thankfully.
Which may be, yep, may be a good thing.
Where they get to view the work they've done to impact the economy, pull consumption down, therefore pull inflation down. And then they meet again in September.
Right.
And we believe that in September, if they do increase rates, it will likely not be 75 basis points. It might be 25 basis points. We say this now, and there are good reasons for it. Number one, we're seeing inflation starting to cool off. Number two, the price of commodities, which was not in this most recent inflation report, they've cooled off across the board by 40% over the past month.
Amazing.
It's amazing, right? So that data has not made its way into the inflation numbers yet, because remember, in July, you get June's number. In August, you get July's number, if that makes sense. So the Fed obviously sees this. They know that many of these inflationary data points are going to drop like a rock, very likely monthly for the second half of this year, and very likely well into next year. There are these other indicators in the bond market where you look out at 5-year inflation expectations, which, Julina, have historically been oddly accurate, pinpointing out inflation over a long period of time. 5-year inflation data is showing about a high 2% range, which is just about back to where it has been for some time.
Right.
So that forward-looking information is certainly rejecting the current and stale inflation information that we're getting. So the trend is definitely lower. I would even say significantly lower. All we need is a time machine to move forward one more quarter, and you will see how rapidly inflation is about to decline. I'm proud to say, Julina, that we called this in January, February. So if you've been listening to these videos, this is something that we had forecasted. The timing was just about right. And don't be fooled by the headline CPI numbers. Look at core. Headline double counts energy and food.
Right. And core again has declined over the last few months.
3 straight months.
Yep. Great. Thank you.
Right.
And we talked, we talked now about the Fed and inflation. Can we talk about the stock valuations?
Absolutely. Absolutely. Why don't you talk about stock valuations?
Well, I think as we were discussing in the introduction here, it's amazing going into the pandemic, everyone was complaining that the market was expensive. And now here we are, we can comfortably say the market's cheap, and we have to question whether or not it's almost too cheap given the economic footprint that we currently lie in. So I'll start there, and I'll let you interject.
Sure. Why don't you bring up a chart so we can prove it? But you're right. So what Julina is referring to is, in a low interest rate environment or a no interest rate environment, investors should be more willing to invest in stocks that have earnings, and you should be willing to pay a premium when risk-free rates are zero, because there is no alternative. However, when interest rates rise and create an alternative to stocks, you should be less willing to pay up for stocks and their earnings that they're promising 10 years from now. And that's exactly what happened. Interest rates have come up enough where they look better than they have. They're still low, but they look better than they have in quite some time, which is certainly more appealing now than 0% rates. In a very basic way, stocks and bonds compete for your money. And when stocks have good earnings and pay good dividends, and bonds have no yields, one would say pile into stocks. When bonds go from no yields to now paying 3%, 4%, 5% in some cases, well, it might make sense to take some of that stock money and move it over to bonds. And it's that rotation between stocks and bonds, when one looks more attractive than the other, and when things change, that moves the markets. Doesn't move them forever, but it moves them in short periods of time.
Sure.
And oftentimes those moves are overdone. So if there's a lot of selling in stocks, it cheapens the market,
Right.
right? Especially in a scenario where earnings aren't really declining, they are increasing. We believe this year they might not increase by 10 or 12%, which is too high anyways. But we think looking at the first half and then sort of lowering the bar for the second half, those two together will actually be an increase year over year in earnings. And in a scenario where stocks priced in earnings not growing, that is where you get us saying stocks are cheap. And the visual of that statement is on this chart in front of you. So on the far right-hand side, you can see the black line with the green dot showing that now the market is below its 25-year average. Keeping in mind, for the past 8 years, 11 years or so, we have been above the average. Now we're going way back to long-term averages. And I think what is not talked about enough is if we go back to the 90s and the early 2000s, we're talking about interest rates that are 2 to 3 times higher than they are today. And that's a place that we're not going.
Absolutely.
The Fed can't do that. The Fed won't do that. And the bond market won't accommodate that. And there are reasons for that. One of them being the rest of the world has rates that are way lower than us. So you're not going to have this high quality country that has economic growth and the best innovation in companies in the world being the highest yielding bond in the world. That makes absolutely no sense. So I'll stop there before it gets too confusing.
Thank you for clarifying that. And I think another point that we talked a lot about in the committee is investor sentiment or confidence.
Yes.
And I think some of the information that we have is fascinating. If you can maybe talk a little bit about what we're seeing here.
Absolutely. These tend to be some of the best indicators of the current and the future. And what you see here is a chart looking at the consumer sentiment levels. So the University of Michigan does its poll every month, and it's charted over time. And then they overlay it over the market. Are you feeling good? Market must be up. Are you feeling bad? Market must be down, so on and so forth. And what you see here, I mean, these are spot on accurate indicators here, that when consumer sentiment is low, future returns are astronomically high. If that is true, which it has been since 1970, then we are in for very good returns over the next 12, 24, and 36 months. I should point out that consumer sentiment, the most recent reading in June, was the lowest ever since they've been keeping track of it. So people feel more negative with a much more negative outlook of the future than they ever have in history.
It's amazing. I mean, that this is including the financial crisis of 08.
Absolutely.
Right? Just to its left here.
Yes. And keep in mind the financial crisis of 08, that negative aura was around for about 4 years. And they kept polling people every month throughout that 4-year period, when there was fraud, when people were foreclosing on their homes, when people were upside down in their homes, when people were unemployed. They were asking people, and it still didn't get that negative. Yet today, where we have, once again, a 60-year low in the unemployment level, everyone has a job that wants a job. Net worth in this country is very close to its all-time high. Equity in people's homes is very close to an all-time high. Cash in bank accounts is very close to an all-time high, right?
Yep.
People
Employment.
have more conveniences, more gadgets, more jobs than ever in history, yet sentiment levels are the lowest they have been in the history of the survey, going back to the 70s.
Absolutely. And I think
I believe the July reading will be even worse, which gives us even more conviction that looking forward, markets are going to rise quite a bit. And we are so confident, it takes a lot to sort of see this chart, but coming out of those troughs, which start with February of 75, May of 80, October of 90, March of 03, October of 05, November of 08, August of 11, and April of 20, the average return 12 months later is 25% on the S&P 500.
In 1 year.
Next 12 months
Yep.
from the reading.
Yep, that's the average. Yep, thank you for clarifying that.
Yes. Another way to view it on the next chart, Julina, if you can pop that one up, to really zoom into the data. Here it is expressed in a different way. 6 months later, the market from these sentiment levels, in essence, the way they measure this one is a level below 56. Right now it's 50, probably trending into the 40s, which means people feel no hope, which means you should invest in the market. 6 months later, the market on average is up 11.51%. It's positive 100% of the time. 9 months later, the average return is up 14.42%. It's positive 100% of the time. 1 year later, again, this is pulling a few more data sets in, up over 20%. It's positive 100% of the time. 2 years later, up 30%, positive 100% of the time. 3 years later, up 52% cumulative, positive 100% of the time. So if you're feeling down, there are good times ahead.
I would agree. Some great reasons for optimism here.
Absolutely.
Sure.
Absolutely.
Absolutely.
Yeah, so that's certainly finding its way into our forecast. We will be attaching a whole slide deck to this presentation. There are other data points that we'd like to show you. One that will help back up our strong conviction for declining inflation would be sort of that chart on commodities. So all commodities have gone down quite rapidly. And Julina, if you can actually show that, it's not really registering in any of these inflationary data points just yet, because it really just happened. But what just happened, I feel like we need to put on a chart and show you. We had the basket of commodities reach a peak early June at a level of 136.61. The most recent reading is registering at 91.16.
That's quite a decline in 1 month.
That is quite a decline in 1 month, but it happened so fast that the inflationary data did not even really pick up on this.
Right.
We are quite positive that it'll be picked up on for the month of July, reported in August. And now you're starting to hear all of those personalities on TV that are saying inflation is going to go to 10, 11, 12, 20%. Now they're starting to cave, realizing that, hey, the price of copper down 50% is probably going to pull inflation down. The price of oil going from 130 to somewhere in the 90s, that'll probably have an impact. The price of gas coming down, the price of lumber coming down 60%, the price of wheat coming down 27%. Yeah, if it had a negative impact going up, it's probably going to have the opposite impact going down.
Right.
Yeah. So
I have to note that I heard Jim Cramer say this morning that he thinks that headline inflation has peaked. And I just want to make note that you heard it from us first.
Hey, yeah, 5 months ago. Julina, if you can actually pull up maybe a chart that no one has seen before, the amount of money that is in the system, that would be the M2, money supply. If you could pull that up, because I think it is a cute chart to show people and really what may have sparked inflation. So if you look at this chart, this is how much money is in the system. And you see this very strange outlier that happened in 2020 and 2021, where more money than we've ever seen cumulatively in history was thrown into the economy. That is, a lot of that really can be summarized as the fiscal spend that was thrown into the economy and the creation of money by the Fed, so on and so forth. And what the Fed has done in no longer creating money, tightening money, increasing interest rates, and letting their balance sheet run off a little bit, they have very rapidly gone from creating a lot of money and having government send it out to there's a fiscal drag, meaning the government is no longer spending money, thankfully, and no longer creating more money for the government to spend. So we had this very wild run up and then a very wild run back down to long-term averages. And that's where it stands. So what we have to do now over time, and I've mentioned this months ago, is we have to burn through a lot of that excess cash. Well, burning through it, in essence, is spending it. And what you have really over the past year or so is people spending money rapidly. And if you just think about this in life, you're more prone to spend found money or money that was handed to you or money that's not yours than you are your own. So, of course, all of that money that was thrown at people in the economy is going to be spent and is being spent, which is why we have this inflation, but then it's going to go back to normal. People do have a way of living within their means over a period of time, and living above their means and then going back to living within your means also creates a little bit of unhappiness, which can be expressed in the consumer sentiment polls, by the way. So I mention all of this because at times we take a bottom-up view, so we don't look at the macro scene, but more often than not, we take a top-down view, which looks at the macro environment in the interconnected pieces that are woven together that can define what and why things are happening. And this is clearly one of them that gets nearly not enough attention that it should. A tremendous amount of excess money being put into the system needs to come out, however it comes out, whether it's taxed or whether it is spent, it's going to come out of the system, and that gets us back to normal. I want to point out one thing for everyone that is talking about a recession. We had tremendous economic growth because the world, the entire world, central banks, not only in the United States, but on every, part of the world, created money and sent it to consumers and businesses, right? At the same time. So that just created a massive amount of demand for similar things at the same time, which, by the way, created supply chain disruptions, especially when coming out of the pandemic, certain parts of the world were open, then closed, open, then closed, open, then closed. That creates disruption where nobody's talking about supply chain issues anymore, right? Because we really don't have them.
Yeah.
You're now hearing stories about excess inventory. Well, excess inventory means, you can buy a Christmas tree for 25 cents from Target right now because they have too many of them. Part of the reason is the ones that they ordered in 2021 just got delivered with all the stuff that they ordered last quarter, right? So you're hearing these stories of excess inventory at Macy's, Target, Walmart, Nordstrom, so on and so forth. A lot of that excess inventory is going to be sent to lumber liquidators and all these liquidation stores, and even stores like TJ Maxx and Marshalls, right? They make a living on the excess supply of big retailers. So there's a lot of stuff that's going to drive prices down, and you're going to see probably enormous holiday savings promotions. Black Friday might turn into a week-long sale. Cyber Monday might be a month-long sale. And, holiday shopping is compared to last year when there were no toys on the shelves, no gifts to be bought, there wasn't stuff to buy. This go round, the shelves are stocked. And that is not an inflationary sign. That is a deflationary sign.
Absolutely.
So going back to what you said in the beginning, it's a tale of two halves. The first half of this year is going to be very different than the second half of this year, or the second half will be very different than the first. Yeah, we have the Fed who will likely increase one more time, maybe two, but the second will be probably a much smaller increase, which could be September. I'm in the camp that believes they might cut by the end of the year. If they don't by the end of the year, they will in 2023. So the opposite of what has been happening in the first half will happen. We had great earnings in the first half of this year. We will have okay earnings in the second half of this year. We had rising hot inflation in the first half of this year. We'll have declining inflation in the second half of this year. Even politics are set to change, right? We didn't even mention that this is a midterm election year, which are always volatile to begin with. We will very likely end the year with divided government, or at least based on current forecasts. How different things are. We should also mention that the strength of the US dollar, it's oddly strong. And right now it's the US dollar versus the euro, they're trading at par. I think that's going to change pretty rapidly. So
that's why everyone's on vacation in Italy.
That's why everyone is on vacation in Italy. And that's why everyone should go to Italy now, because your dollars will go much further. And if you're planning on going to Italy or Europe anytime soon, you probably want to buy some euros today from your local bank and lock that price in, because it could save you about 20%. That's a sale. So I would, if you're thinking about going to Europe, buy your euros now, call your bank, call Bank of America, Wells Fargo, JP Morgan, or whoever you bank with, and buy some euros. So I'm serious. It's that's how big the spread is right now. You right. Typically don't see this. So, cool. Yeah. So again, there's a lot of optimism for the second half. Does it mean the market is done going down? It doesn't. But down from here is technical. Down from here is institution shorting. Yeah. There's not a lot of fundamental reasons for the down. And always remember that the economy is going to sound worse. I guess the other second half is the economy was as strong as it was ever in history in the first half. It's going to be less strong in the second half, but I don't believe it's going to be weak at all. If we have a recession, it's going to be the first recession ever in history with peak employment, with peak home equity levels, with record amounts of cash on the sideline for businesses and consumers, with record amounts of consumption, not only in the US, but globally. So, the Fed knows that, and that's why they're sort of pushing against the grain. Absolutely. They're flirting that line. So, but certainly the economy will be weaker than the economy was in the first half, but that's silly because it was never stronger. So.
Absolutely. And thank you for that very, very important note and for the summary in regards to all of our optimism across all of these topics and indicators that we're looking at. Can I end with, if I want to give one more reason for optimism before we sign off, and if I can share one more slide that I think is also incredibly important in terms of the opportunity and just talking about this very difficult quarter that we went through. And again, looking at all the data and all the previous declines, a quarterly decline, of more than 15%, going back to the 50s, right? There's not a lot of them. There's a handful though, but it is amazing at all the green you see on the right-hand side of this page, looking 1 quarter out, 2 quarters out, and then looking a year out. It's all very, very indicative of good returns ahead.
Yeah, and just to explain this a little further, so 1 quarter out, the average return is about 8% higher. 2 quarters out, the average return is about 15% higher. 4 quarters out, the average return is almost 30%. And 2 quarters and 4 quarters out, the hit rate or the positive rate is 100%. So it just goes to show you, a little hindsight bias. All prior declines look like an opportunity, and all current declines look like risk. And if you really think about that, all declines are opportunities. all declines are opportunities,
Absolutely.
especially the deep ones.
Absolutely.
Especially the deep ones. If this were a 6.5% decline, we wouldn't be doing a video. That's like just a bad month. But we had a bear market drawdown in the market. We had a greater than 15% decline in a quarter, which was Q2 of this year, where the S&P went down 16.9%, very rare. So we're telling you, look, deep declines create very steep increases pretty quickly. And this is also backing up there's no reason to flee the market when you're getting a yield of 3 to 5% while you wait for a 20%, 30% recovery to happen. If you do that, you better have spectacular timing. You better be able to part the sea of terrible news and good news and political news and nightly news and mass media news. And you better be able to hit that button against the grain of what everyone is saying. Stay invested in good stuff, and good stuff rewards you pretty quickly and almost all the time. So
that's a great point, and
yeah.
I think it's a great one to sort of end on. Bob, again, we appreciate your insight and your thoughtfulness on what we see happening, and we will obviously continue to do that going forward. I will also suggest to everyone that if you have any questions, please reach out to any of us here at Principal Wealth Partners. We're here for you.
Yeah, absolutely. And coming this fall, we have a few events. One from Fidelity Investments, where they're even talking about the capital markets. And I think that'll be quite helpful. We'll be sending out invitations for that. And then we have a political analyst and economist joining us in October, just prior to the election. We'll be sending out invites for that as well. So again, we're trying to keep you educated, informed, trying to give you some color behind our recommendations, some color behind the changes that we're making in portfolios, and hopefully over time that just clarifies what we're doing and why, what we see, and all of that hopefully gets you through tough times, and good times are easy. So
yep. Can't wait. Well, thank you, Bob, and thank you everyone for your listening, for your time, and for your trust in us.
Great. Thank you.